Welcome back to QAV. Tony, this is episode 609. We're recording this on the 28th of February, 2023. About, 1:13 p.m. Brisbane time, 2:13 p.m. Cape Shake time. How's life down at the Cape property, Tony?
Oh, lovely. Jen's down here this week, so we're having a break, which is lovely. Yeah, we've just been relaxing and doing jigsaws and went out for lunch yesterday. Yeah, it's all good. She's having a massage tomorrow. I'm playing golf.
Jigsaws?
Oh, yeah, I love the jigsaws down here. It's good.
Are these some of the ones that Taylor sold you during COVID?
Oh, we've done those years and years ago, so I don't know where they are. No, I got 3 for Christmas because people know I like doing them down here. So
wow.
Jenny gave me one of a map of the Mornington Peninsula, like a hand-drawn painting of all the attractions and things. So that was good. Just finished that one. Alex has given me one of the Eiffel Tower, I guess in reference to our trip we did with you to Europe. So I'm doing that one next. And I've got another one from my sister of some windmills and tulips. So I'll save that one till last.
I would rather have my toenails slowly pulled out with a pair of pliers. Chrissy's into doing
that
Lego
can be arranged.
That's something Chrissy will arrange, I think, in time. She loves doing Lego. I bought her like one of the adult Lego sets for her birthday. It's a bunch of flowers to go in a vase.
I know it.
Which she loves doing it. I can't think of anything worse. Like
I
fiddly
love Lego.
things.
I love Lego. Yeah.
Oh, I hate fiddly things. As a kid, used to get those, the model airplanes and stuff. I hated them.
I loved it. Okay.
I don't have good fingers or patience for that kind of stuff.
No, I love it. I've always loved that sort of stuff. I used to make a lot of Lego when I was a kid and love designing new things too. Helicopters and hovercrafts and all sorts of things. It was great fun. I religiously buy them for my nieces and nephews as presents.
Oh, Fox is obsessed with Lego. You should come and spend a day in his room. It's like a Lego zoo in his room. I should send you some photos. He loves it.
Please.
It's good. Like he's been watching. Do you know this? You probably don't, but there's a YouTuber called Mark Rober. He's an ex-NASA and Apple engineer, and now he's got like 25 million followers on YouTube. He does engineering videos. A couple of his most famous ones, he designed a glitter bomb to go on a package on front doorsteps to stop people stealing packages in the US. Yeah. And then he's done a couple of versions of that. And then he did another very famous one where he built like a series of hurdles for squirrels in his backyard where they had to achieve certain challenges to get the walnuts, which was very big. Anyway, he's done 1 million, and they're all engineering based, and they're great. He's really, really good. And Fox is obsessed with his stuff. But he said to me the other day, I think I want to be an engineer when I grow up, which is cool, right? I was like, that's good on Mark Rober. He's inspiring kids to become engineers, or at least to think about it as an option, because he makes he makes being an engineer look cool. So that's great. I love it.
That is good.
And I think Lego's part of that too. He loves then going and designing stuff and building stuff in Lego. I think Lego's fabulous. Drives me nuts, but I think it's great.
I must admit, I prefer the way Lego used to be when I was a kid, where you just buy a box of bricks and then you could make your own things out of it. Whereas now because of all the franchises, you're pretty much stuck building the Star Wars, figurine that they give you. The X-Wing fighter, all the parts are sort of pre-made for that now, which I don't really like as much as being able to design your own X-Wing fighter and build it from scratch.
Yeah. Well, I think you can still do that. You can still go and buy just the basic bricks, but the stores are more designed for the custom builds, but they must be a great business. Like how much, what would it cost to churn out a Lego brick? Like fractions, microcents. They sell them for the Eiffel Tower one's like $1,000.
Yeah. It's a great story. I mean, I'm just trying to remember where I saw it. There must have been a documentary about it, but the guy who did it, I've forgotten his name now, back in the 20s or whatever, built wooden toys first of all. and then plastics came in, and he eventually came up with the current design, which was the circle, which is the Lego clutch, where two bricks hold together with no sort of binding because of the circles on top and the hollow underneath. Yeah, and it just went on from there.
Yeah, really great success story.
I'll show Fox that James May's Toy Stories. There's a whole episode in there where he builds a house from scratch out of Lego,
really?
a real house that you can go into, including that he builds a toilet and puts a brown Lego brick in the bottom of it.
that would appeal to Fox. That's
Exactly.
8-year-old boy humor. Yeah.
Yeah.
Anyway, let's get on to less happy stories. Tough day. Tough day in the market yesterday. It's recovered a little bit today, I notice. Like it's rebounded quite a bit today, sort of 50% of the dive yesterday, but it just dived from 7,512 yesterday morning to 7,432 and then bounced around a little bit in the afternoon, according to, I don't know, Perth Now, talking from the AAAP. Local share market has suffered its worst day of losses in almost 8 weeks following signs inflation in the US is proving remarkably sticky. The S&P ASX 200 index finished Monday down 82.2 points, or 1.12%, to 7,224.8, while the broader All Ordinaries dropped 93.1 points, or 1.24%, to 7,419.6. It was the ASX's second worst performance of the year after a decline on January 3rd. So look, lift your game, US. You're hurting our markets.
Well, or lower your game, US. The problem over there is inflation's higher than what people thought it was. So people are still spending, and therefore the analysts are now forecasting a 0.5% increase in interest rates at the next reserve meeting over there. Yeah, but like again, this is we'll talk about it when we talk about the Buffett letter. But again, so inflation came out. I don't know what I think they were expecting 4.5%, and it was 4.8, something like that. Could have the numbers wrong, but it was 30 basis points higher than what they thought, and they go bananas. I think the US market dropped 1.8% on Friday. Which is, one of the difficulties of being an Australian investor is you see that on Saturday morning when you wake up and you think, shit, I can't do anything about it because I know on Monday the market's going to open here, it's going to go down. So
yeah,
just have to wade through it. But our market didn't go down as far as the US. I think what did I read on the weekend? The US market was down 2.7 or 2.8% for the week, which is a huge fall. So there's still, still a fair bit to happen to come to grips with inflation at the moment. Still got to play out.
I think the thing that's been boggling my mind over the last week or two, we talked about this last week, is all of these companies coming out with great looking reports in Australia, half-yearly reports. They've obviously had a bit of a tailwind over the last, or some of them over the last year because of the Ukraine war and supply side issues and all these sorts of things, and then on the other side, you've got inflation and interest rates going up. But, they're coming out with record profits and then their share price will just tank. And, I've seen people in our forums just scratching their heads about it. And, in some cases, they've reported a good half-yearly result, but their projections for the rest of the year aren't too strong. In other cases, their projections are fine. I think XTE was an example yesterday, but the share price still just took a beating. And
someone's asked the question about that, so I'll save my comments until then. But
okay.
I did note XTE's gone through its 3-point trend line sell price today. I think you were saying beforehand you had to sell it from the dummy portfolio.
Yeah, I held on this morning because it was only 1 cent below the 3PTL, and I thought, the market's going to be up today, they say, so I'll go to Kung Fu and I'll worry about it when I get home. I got home and it dropped down to 58.5 cents. So I was like, oh, damn it. Speaking of things breaking through their 3PTL, I was just talking to you before the show about GNC, GrainCorp, and you pointed out that there is a futures chart on Stock Doctor for wheat. And when we had a look at it, it's W hash for people that want to have a look at it. Wheat is a Josephine and is about to become a sell by the looks of it. It's
Possibly,
very,
yeah.
very close to the sell line, which means we'll have to dump our GNC. And is there anything else that's grain related that we should look at that's on our buy list often?
I can't think of it. Grain Corp's probably the only one. And that's the grain handle that sends things overseas. It does tend to perform along with the grain price. And it's bottomed out and it's going up again, like just bottomed out in the last 3 or 4 months, and it's going up again. So it's climbing up in a zigzag pattern. So even though it crosses, it may well come back if it does cross its sell line going up.
Well, so that's we'll start tracking that as of this week in our com status tab in the buy list.
Yeah, I did notice a couple of other reports came out for stocks on the buy list and stocks I own. So Woodside reported just recently, tripled its profit, largely due to the merger with the BHP oil and gas operations, and its dividends way up as well. So that was a good result. Stanmore Coal I saw came out, the coking coal provider, and their profit was 20 times last year's numbers, but their share price went down. So there you go. Yeah, I think analysts are kind of looking for future guidance in particular. They always are, but in particular now, because they know that it's been a good half, they want to know what's going to happen. And if they don't get every I dotted and every T crossed when they're presenting the share, the companies can have their stock price marked down. Like, for example, Qantas was the other one I was going to mention. Their profit, they haven't made a profit for 3 years, I think, and this is the first year they have. They made $1 billion, and their share price came off 10%, largely because people thought it was as good as it was going to get, and with increased competition, they won't be able to maintain their margins. Yeah, I mean, the funny thing is, like, nothing changed from the day before the results were announced in terms of the competition or the issues that caused the sell-off. So there was obviously some kind of there was probably something in the results announcement which someone picked up on and extrapolated from. But Qantas went down. It's back up again today. I've bought some. I'm not sure that kind of 10% sell-off in a day is the right reaction to a good result, really. So we'll see.
There's that old saying too: buy on the rumor, sell on the facts.
Yeah.
You think a lot of the funds buy if they think they're going to have a good result, then they report the good result, and then they just take their profits and move on.
Oh, it's possible. I haven't heard of anyone doing that, but it's possible. Yeah.
All right, well, let's talk about the QAV report just quickly. The dummy portfolio improved a bit again this last week, surprisingly. We're up about 16.14% CAGR per annum over the, what is it now, September 2019, 3.5 years, a little bit less, versus the benchmark, which retreated a little bit last week. It's now up 7.09% CAGR per annum. So we're doing a little bit better than double the benchmark since inception. For the financial year, we're still way behind, though. We're up 6.48% versus the STW up 17.96%. In the last 7 days, took a beating from AMP. I actually had to sell AMP out of the dummy portfolio yesterday. It's the first thing I've had to sell since I think about November. So it's been a good run for the dummy portfolio, but yeah, AMP took a real beating over the last couple of weeks. And I ended up buying 3 stocks to replace it because I had 2 parcels of AMP, double the pain.
I'm in the same boat. Yeah.
Yeah. HLI, DUR, and BRI are what I replaced it with, and I have no idea how they're doing today. But yeah, we'll see. We had a Yahoo Finance article go up, and I have to congratulate Phil Muscatello. Phil from Shares for Beginners emailed me this morning and said, "Hey, I just had a huge spike in my traffic, and I went to look, and it's this Yahoo Finance article that's written about Tony. Apparently Taylor wrote it, and I said, yeah, kind of. And then I emailed it to Taylor and said, hey, Phil got a spike. And Taylor went and had a look. And apparently in the article where it says Tony, co-host of the QAV podcast, instead of linking to our website, he linked to Phil's website.
Oh, no.
He said, oh, you're going to hate me. He said, I must have just, I don't know, Googled Tony's name and pulled a link up. I'm like, dude, what the hell? So you're welcome, Phil, for all that free traffic. Taylor called me last night before we worked this out and told me it was the #1 trending article on Yahoo Finance yesterday was that article. So if people haven't seen that, go up to Yahoo Finance. It was called something like 3 life lessons from one of Australia's best investors. What were the 3 life lessons, Tony?
Just start early, start investing early, beat a snowball, buy a house and pay it off, and don't do things that are cool. They were the 3 life lessons.
Yeah. Very good. Well, thank you for your contribution to Phil's listenership. You owe us, Phil.
That's funny. Yeah.
You owe us one.
So does Taylor.
Jeez, what are you going to do? Ray Dalio is exiting Bridgewater. I read this big article on him the other day. Hedge fund multi-billionaire paid billions to quit his own company. One of Wall Street's most powerful titans will be paid billions to walk away from the $180 billion hedge fund he founded in his New York flat almost 50 years ago. According to a report by the New York Times, US multi-billionaire Ray Dalio had negotiated secret regular payments through a special class of stock informally named Ray shares worth billions of dollars. Dalio, who has an estimated net worth of $27.4 billion, gave up control of Bridgewater in October, the mighty hedge fund, which manages $180 billion in capital. Although the 73-year-old retired last year, he kept his seat on the firm's board. What a piker. Like, Warren and Charlie are still going into their 90s. He stepped away. I hadn't heard about that. Had you heard about that?
I've read a similar article. I'm just making a note now about being paid to leave the company, though, once I get...
Yeah.
73, yeah. A few $billion. That'd be nice. Secret shares.
Yeah.
It tells you where his head is at, though, isn't it? Like, he's being paid billions to step down in secret, and Warren's giving away 90% of his wealth to charity.
Yeah. And I see Ray on, I don't know, Instagram or TikTok or something from time to time. He does a lot of video content. I hadn't heard him talk about him leaving. But yeah, no, it's interesting. I guess he's got other things he wants to do, but it's I don't know. I just can't imagine building something like that and walking away from it. Must have his reasons.
Being paid well too.
Well, speaking of decisions, we were quoting Charlie Munger last week about, he said it's something like the #1 problem he sees in businesses is denying reality, how things change and people just can't get their head around it, deny the reality of the situation, keep doing what they've always been doing. And then I saw, I think the next day, in the Financial Review, an opinion article by senior correspondent Aaron Patrick entitled "The Reality Defying Optimism of ASX CEOs." The gap between how some CEOs describe their company's performance and reality seems to have become unusually large. BlueScope's 64% profit fall was encouraging, Chief Executive Mark Vassella wrote in the Steelmakers earnings statement on Monday, because it demonstrated the company's resilience when prices dropped. In an interview on Sky News, he argued that after very high steel prices, what we are seeing here is a reversion to a more normalized steel price. Still, The outlook is bright. There are massive plans for building green energy infrastructure in North America, he said, and quite a backlog of demand for cars. Vasella was promoting his stock. The pitch failed. He ignored or glossed over reality. BlueScope shares fell 10% on Monday after investors worked out that the results included a $100 million profit downgrade. And then he goes on to say the CEO sales job, and we've talked about this on the show many times in the past. All CEOs are salesmen. They sell themselves to staff, directors, customers, and shareholders. They're paid optimists. A public company CEO who says, we really blew it this half, but there's a 50-50 chance we can turn the business around in 2 years, is unlikely to survive long, no matter how honest the statement. But the gap between how some CEOs describe their company's performance and reality seems to have become unusually large. Now, you've known a lot of CEOs in your time. You've watched a lot. You've played up in the upper echelons of the corporate world, Tony. Your wife has been up in the upper echelons for most of her career. What do you think about CEOs and denying reality? Is it getting worse, or has it always been a problem? Or is it what they're paid to do, deny reality?
Well, it's always been a problem, and it is what they're paid to do. I wouldn't call it denying reality, because I think they understand perfectly well what the reality is. But they're spin doctors. That's right. I've always felt very uncomfortable around people who do that. I think it's psychopathic myself. It's just to know, like, to stand in a meeting and watch the CEO lie, basically, trying to put a spin on trying to shine up a piece of shit and to make it shine, which is their job. So I get it, but they could take a leaf out of Warren Buffett's book. I mean, you look at almost every year he starts off with his annual letter, and I fucked up, people. I made a mistake. I made this mistake. I made that mistake. And that just gets it straight off, out of the way, clears the deck. You actually feel a bit sympathetic for him, and then he tells you about the results. So, yeah.
The difference being that Warren can't get fired.
Well, that's true. Yeah, no, that's true. So he doesn't have to sing for his supper, which I guess is that's how these people get into, it's evolutionary, really. The person who gets the top job in a public company, unless they're the founder or the son of the founder or daughter of the founder, they're generally someone who's just been successful at hiding problems and managing upwards. That's really all it is. I've seen it 100 times. It's annoying because they're not the best person to run the company, not even close to the best person to run the company, but they just happen to be the one that evolutionarily succeeds. And don't forget, there's survivor bias here. There's another 100 people who tried to put good spin on things who got found out and didn't get promoted. So, that's below the person who's spinning are the people who's copying the spinner. So doesn't bode well for these organisations either. But yeah, I'm not a fan of it. I don't see how anyone could be a fan of it, and I don't see how they think they can be doing a good job for their company by spinning like that. It's just it's patent lying, really.
And why are the boards allowing them to do this? I mean, it's the boards that hire them. It's the boards that fire them. Surely the people on the boards are smart enough to know when they're spinning everything and things aren't going well. Are their conversations with the board different to their conversations to the staff and the public?
No, oftentimes the board's ex-CEOs.
So they're
the past masters. Absolutely. I mean, I've sat in board meetings where they spend 2 hours over a sentence, but if we say this, they'll think that. If we say this, it'll look better. It's just, you've got to do a certain amount of that, and you've got to have things legal, and the PR people will get involved to try and spin it the best. But yeah, there's a lot of time and effort devoted in public companies to signing off on announcements that then bomb because they're patently lies. Yeah, and it comes back to continuous disclosure too. I mean, technically, you use the BlueScope example, and I don't know it in detail, but if it took them to the market announcement of their results to discover a $100 million profit shortfall, and the CEO didn't call it out even during the announcement, how is that continuous disclosure to the market? Yeah. So I mean, that's the game, isn't it? That so you know, I probably shouldn't pick on BlueScope because I don't know the details of the situation, but you'd have to say they found a problem and they said, okay, we can go to the market and tell them and suffer a share price reduction now, or we can try and dance a bit faster, see if the problem goes away. And then when the results come out and we have to tell them, we'll just try and hide it and spin it. And it's just, I mean, it's just shocking corporate governance. It really is.
Reminds me of something Warren said in his annual letter, which we'll get to next. But speaking of psychopaths, I don't know if you saw my post about this, but some political scientist in the US has just come out with a book about psychopaths in power and how they're the cause of a lot of the world's problems. And it's getting a ton of media coverage.
Really? Yeah.
Obviously got a much better publisher than we had for our book 3 years ago that said exactly the same thing.
Get Tyler to write a Yahoo Finance article and then link it to our book rather than his.
He'll link it to this guy's book, probably. Yeah.
But also the other leaf out of Warren Buffett's book is he doesn't give guidance. He just says, you know, I'm not going to give guidance because I don't want you playing with the share price based on what you think is going to happen, or, you know, I can't forecast in 12 months what's going to happen, so I'm not going to give guidance. But, you know, clearly in some of the cases we're talking about, they love to go out at the start of the year and say, oh, it's going to be fantastic this year. We're doing this, that, and the other thing, and building new green steel works and all this kind of stuff. And then, you know, hopefully the share price goes up and they can cash in, or they can leave before the chickens come home to roost.
Which, you know, I guess the bottom line is what you've taught us for the last 3 or 4 years we've been doing the show is don't listen to the stories. If I want to hear a story, I'll buy a book. Mm-hmm. Don't listen to the stories that the media are telling you, that the CEOs are telling you. Just look at the facts. And the facts are demonstrated by the numbers, which is why we look at the numbers.
And not even all the numbers, as again we'll see in Warren's letter. Look at the ones they can't manipulate easily.
The real numbers.
Look at cash flow. Yeah.
So it was Christmas for value investors this week. The Berkshire Hathaway annual letter from Warren came out, and oh my God, it was such a great read. There's so many great lines in this. I know you've got a bunch of things you want to talk about. I'll kick it off with some of my favorite quotes from it. The disposition of money unmasks humans.
Mr. Dalio.
Yeah, I really like that. I mean, it's you know, there's a saying that I used in our psychopath book, and so did this other guy. Power corrupts and absolute power corrupts absolutely. But you see that money unmasks, you know, people's real levels of honesty and integrity and how they deal with money. Money and children and power are three things that, and animals, where people's true character tends to come out. But I thought that was nicely put. The disposition of money unmasks humans.
And what I think what Warren was talking about there was that a lot of the shareholders in Berkshire Hathaway have signed up for the giving pledge, and they're giving away their outsized fortunes rather than create dynasties. And pass it on. Yeah. So and Buffett goes on to say he likes managing a company where his shareholders share that same kind of mentality.
Yeah. Another quote from Warren: our goal in both forms of ownership, talking about owning 100% of businesses or owning just a stake in them in publicly traded companies, is to make meaningful investments in businesses with both long-lasting, favorable economic characteristics and trustworthy managers. Please note particularly that we own publicly traded stocks based on our expectations about their long-term business performance, not because we view them as vehicles for adroit purchases and sales. That point is crucial. Charlie and I are not stock pickers, we are business pickers.
And that is somewhat different to the approach I have. I'm more like an earlier Warren Buffett who was looking for deep value. But he's the situation he's got hundreds of billions of dollars to invest. And he wants to invest once and move on. He doesn't want to continue to manage that investment and look for time to sell and all that kind of stuff. So he has evolved to invest the way he does, to look for long-term businesses. And he's quite happy to say he'd rather buy a long-term investment like that at a fair value than a business that may not be long-term at a cheap value or cheaper
But I
value.
think we tend to be looking at business performance as well. We're trying to buy shares in good performing businesses with a good history of performance, where we can get them undervalued when they're undervalued. Difference being that if we will sell them if we think their underlying, like if the share price drops below our buy price to save money, or if the sentiment turns against them for some reason in the marketplace, we will save our capital and put it somewhere else.
Yeah.